What is up, everybody? Monday, November 24th. This is the Macro Ghost giving you the best TA and FA and opinions on the internet in under 10 minutes. And those 10 minutes have started now. So let's get to it. Happy Thanksgiving in America. I'm also American. My fellow Americans, happy Thanksgiving. We did see Bitcoin. Well, we saw MicroStrategy. I like to call it Mr. We saw Mr. slice through the Gaussian, and we saw it go first, right? And we saw Bitcoin kind of teasing around there and then going after MicroStrategy. And the bottom of the Gaussian is support. It lended its support. So now I think we're going to oscillate between 93 and 80K. I don't expect much to happen this week due to being a holiday, but there is a gap, I believe, on the downside from this weekend because it looks like we're opening around 87,372, and we didn't close there. So I think that gap should be filled by Tuesday, so nothing major. What I'd like to discuss today is inflation, the Fed funds rate, the Federal Reserve, their opinion, and why they're always wrong. They were wrong in 2008, they were wrong in 2000, they were late. They were late in 2007, 2008 when the crisis happened to decrease rates, and they're late again. And being late is because their data is bad. They use data that's lagged. And on top of that, the government was shut down. So now the market is trading pretty volatile without even remotely good data. The data that I have now that I'm using on Yahoo Finance, rents are falling nationwide. That's great for us in terms of investors. Why is that great? It's great because rents are the biggest single component of CPI, PCE, Consumer Price Index, inflation. Okay, so when rents are falling, that tells me inflation is falling. Now this is lagged, okay? So if I'm going to put on my mathematics hat, I'm going to say if rents are falling in the lagged past, they should be falling also in the present and future because the economy is slowing. The pace of prices is slowing. You want that. You don't want prices to be flying high. And because of that, the Fed Watch tool has now spiked up to 70% based on the chairman of the Fed, Chairman Williams, suggested that a cut remains a possibility. And it's going to be a close call. Some will be dissenting. Some will be in favor of it. Again, volatility here from 73% probability to 39% a day earlier. That's because two Fed chairs that are voting Fed chairs said that they oppose an interest rate in December. So you have some uncertainty. The market hates that. But what I'm coming to tell you is that these Fed chairs are wrong, the ones that oppose it, because jobs are going away to AI. This is a known. Jobs are going away. Microsoft, Apple, Meta, Nvidia, even like UPS, they're being replaced by AI. Even logistics are replacing jobs at a nice clip by AI. Nobody's really picking that up yet. When jobs get replaced, GDP is going to fall because people that had jobs and had money and had salary don't. They have to cut back, and that cuts back spending, that cuts back GDP. So when unemployment's rising, GDP is going to, in the future, fall. That's going to cause recession. That's also going to cause inflation to cool down, which inflation has already cooled down. So there should be no reason to not cut rates and cut them hard. Trump has a point. They should be cutting rates, and especially because of U.S. debt. U.S. debt needs those rates to come down, or the U.S. won't be able to pay back their interest payments. So yeah, the market is trading on that, on this information. And Bitcoin, you might see a bounce because Bitcoin's a risk asset, and the S&P, the NASDAQ, the Dow, you're going to start to see bounces based on interest rates projecting to come down. And I just wanted to cover why stocks need rates to go down to go up. Well, the stock is just a present value of cash flows divided by rate and time. So on the numerator of the stock equation, you have earnings growth expectations because That's the future, expectations of earnings, of revenue, of growth. And the denominator, you have the interest rate. And the denominator is a very interesting tool because if you increase interest rates, you have lower stock prices. Why? Because let's say the numerator is 100. That's their earnings for the year, $100. And the denominator is 1 plus the rate. So if the rate is 5%, which it was, a stock's price is going to be 1. This is very simple, okay? There's probably listeners that are saying, well, this is a very simple explanation for everybody that doesn't know this. So I'm trying to be as simple as possible so that people can understand. When a rate is 5%, the stock price will be 95.2. 100 divided by 1 plus 0.05 is 95.2. You can do that math. There it is right there. But when rates are 0.02, the stock will be 98. So the stock's revenue, earnings is 100, and then a rate is 0.02, the stock price is going to be 98. So which one do we like more? Do we like 98? Do we like Google's price at 98 or 95.2? We like Google's price at 98 because it makes us money. We bought it lower. And so that's why, that's the why. If you guys wanted to know the why of why the markets are volatile, why there's uncertainty, why there's choppiness, why things are happening. I had another article here that said that one analyst said the market is topped. Okay, that doesn't necessarily mean that it has, but we can cover the fact of why it's topped, because a top will be put in on the most certain time. So you're going to get a top because people expect the market to go up later, so they're bidding it up, right? There's the top, right? People are max bullish right there. Bring up the S&P. S&P, okay, doesn't want to come up. Well, that puts a hamper on things. You bring up the S&P, there we go. That could be the top. I don't like calling tops, but that could be the top because look at that bearish divergence, Jesus. But I do like that. I like seeing a huge sell-off in RSI without a big price movement. That's good. That's good, everybody. So that means price can keep going up. So I don't like calling tops or bottoms because I'm generally wrong and I'm not arrogant about it. But I like to see that. Makes me bullish. If there's no more interest rate cuts, this can come down. Why? Because of the model I just showed you is that in a higher interest rate environment, people are going to scale back their expectations of the future. And the top will be put in. People are going to sell. They're going to take profits. Do I think that's what's happening? Let's see here. No, I think we're going to go higher. There, I said it. But that's because everybody is a holder here. Nobody is a short seller. But I'm prepared for that to be the top. But I think we do go higher, just based on what I see on the RSI here. I think we might get a little bit more of a sell-off, maybe. And there we go. Maybe down to here. And give the RSA a full reset, like down to the midline, or even lower. If we come down to here, right, 61.30. And then more cuts will come in, more cuts, inflation will be tamed. And then the market will say, okay, we're confident again. We're going to start buying stocks again. Right? So there's two scenarios I see. One scenario is there's three scenarios actually. One scenario is they do nothing and the market goes sideways. Another scenario is unemployment picks up rapidly, which I think it will, and they're going to start cutting aggressively. And the last scenario is they increase rates, which I give like a 2% probability to, based on, if unemployment calms down and inflation ticks up, they're going to increase rates. But I give that like 2 to 5%. So that's what I wanted to say about today and before Thanksgiving. I do think Bitcoin is is according to its cycle. So yeah, I think it's a wrap. I'm in stocks. I'm not in too much Bitcoin anymore or crypto. Um, Not a good looking chart. But you know, the quicker we get done with this bear market, the quicker I can become bullish. Like we went from 15 to 126K. That's like a 7.5x, something like that. 15, 16 to 126. Somebody do the math. It's between 5 and 10x. It's like a 7x, 7.5x. Um, so I don't necessarily think we have to come down 80% from the highs, but maybe come down to 70 or 50 or 40 even, and put in a low by October 2026. So look for this. Look for something like this, like bounce, down, up. That's a pretty good drawing. That's what I would look for. And yeah, until then, I don't know if this is going to be my last broadcast this week because it is Thanksgiving and the market's going to be closed. And I do want to wait to get my new microphone. I want that new microphone. I bought a very professional one. Hopefully, it'll make my fucking broadcast sound better. But yeah, that's it for today. I hope you enjoyed this conversation about inflation, prices, present value, etc. And I'll see you sometime soon. I'll leave some shorts up there for people to give teasers on what I'm going to bring to the market in the next show. Peace.